quickly as possible so we can stay sort of on schedule. Late. Okay, next. Okay, we always have some cartoons we start off with. This sums up current monetary policy in the U.S. The cartoon, it's a Federal Reserve meeting. They're just going to print more money, make more speeches. That's what they've done for 5 years, 6 years. So that sums it up. That's what we got to know next. Okay, this is the stock market rally explained. You know, the Fed just keeps pumping money, printing money, goes right into the stock market, makes it go up. And we're going to see a chart later. We've seen this chart, a variation of it many times. That, you know, as the Fed does this quantitative easing of money printing, that money goes right into the stock market, makes the stock market go up. So if they stop doing that, it's going to have a bad effect. Okay, next. Okay, the U.S. roundup, we're going to do the U.S. and global foreign. GDP, the first quarter of this year was minus 2.1%. It actually was a whole range of figures from plus 0.1 to minus 2.9, and they've now compromised at the minus 2.1. But if there could be such a huge variation in the case, they have no idea what the number is. It's something bad. Now, Q2, the GDP is really high. It was originally 4.0, now it's 4.2. This is not believable or credible. No U.S. government statistics, economic statistics are actually believable. The latest jobs report was plus 142,000. We're going to see a chart on this. It was much bigger the month before. It turns out this has happened over many years. It's happened whenever there's a really big report, there's a small report. So it indicates it's really just some statistical quirk in the way they do the figures, which are quite quirky. The unemployment rate is 6.1%. This is highly unrealistic. It does not include people that have left the labor force. That number has hit a record high of people out of the labor force, 92.3 million. The participation rate, that's people who are actually working, is at 62.8%. That's a 36-year low. That goes back to the 70s. And what happened, in case you don't remember or you were too young, women influxed into the labor force very heavily in the 1970s and a little less in the 80s. In the 50s and 60s, most women did not work. They stayed home, they took care of children. Now you have two-career couples is the norm. So the participation rate in the labor force went up and up and up into the 70s, even the 80s, and maybe even the 90s. And now it's going back and back and back and back and back. And it's not so much that the women stop working, it's just lots of people just stop working. And these people are not counted as unemployed. So this makes the unemployment rate look much better. Of course, if they don't have a job, of course, but hey, they're not in the labor force, so who cares? So it's the statistics look good, but they're not very good. This is very artificial. The Fed reverted quantitative easing. David mentioned it. It's at 25 billion right now. It will be 15 billion at the next meeting in a few days. Then it'll be 5 billion in October. And I think it'll be 5 billion, might actually be 0. So it ends in October or November. So that money that's been keeping the stock market up is just going to peter out and disappear. And we're going to see what that's happened. They've done this twice. We're going to see what happened when they did it previously. It was not good. So Fed funds have been at 0 since December 2008. So that's almost 6 years. So, and that's highly stimulative, the very, very low interest rates. And they're 0 in Japan, and they're, you know, a little above 0 in the EU, and a little above that in the UK. So they're around 0 in the entire world. This is unbelievably stimulative of the economy. And the economy is not doing well in most places. Now, Japan has had 0% interest rates, we're going to see this in a little later too, since the 90s. And the economy has been a complete and total wreck that entire time. So we have a live case of, hey, this does not work. So all the other main countries in the world copy them and think it's going to work for them, even though it doesn't work. So next. Okay, we did this chart previously. This is just U.S. long-term GDP from the 50s. You see there is this downtrend that's been going on for decades. Now, this is based on the official GDP figures. which have been highly manipulated since the 80s, 90s, particularly in the 2000s, and that's because their GDP is adjusted for inflation, and inflation has been grossly understated, so that overstates GDP. If you use a realistic inflation rate, GDP would have been negative almost the entire time since 2000. So we've had not only no economic growth, we've actually had economic decline since that time. And it's been hidden because the government lies about the statistics. And by the way, I have a degree in statistics, so this is the basis that I made this statement. Next. Here is shadow stats. They do a very good job. Their statistics are the inflation rates are the blue ones. The red ones are the official government rates. Notice that they were saying until around 1983, and then they started to diverge. At that point, the U.S. government started to add all sorts of improvements on inflation calculations, and the improvements made them look better and make the politicians look better and say, hey, we elected me, look how I kept inflation down. So, it's just another more sophisticated form of lying. And all this shadow stats does, it just goes back and recalculates the current inflation rate based on how it was done in the 1970s, before all these, quote, improvements were made. Now, if you want to compare figures over time, you must calculate them in the same way. So the only legitimate comparisons would be that blue line. The red one is not legitimate because the method of calculation changed over time. So you see inflation is way higher. This is not just in the United States. This is in probably every country on earth. There's an extreme example in Argentina that we've spoken about. I use a rule of thumb, multiply by 3 to get the actual inflation rate, whatever the government is telling you anywhere. Now, Argentina, the government was claiming the inflation rate was 10%. Everyone knew it was a lie on the street. You could ask anyone walking down the street, the supermarket, the bus, and everything. And they'd say, 10%, 30%. They all knew it was 30%. So they were forced to, like we do, how they calculated the inflation rate, and then it turned out to be 50%. So they knew it was a lie, no one believed it. Americans actually believe this. It's discussed in the press like, oh, this is realistic. It's not realistic. It's a complete joke. It's logically deficient and absurd. You just have to go to the supermarket. I've seen prices I've never seen in the last few months. Incredibly high prices. And they'll say, oh, there's 2% inflation. You look in the supermarket, it's like 20% inflation. Okay, next. Real wage growth in the U.S. This is just a chart I found on the internet. Notice it's at 0. And this is using official figures. This is using the government figures, which are grossly overstated. So the real number is not 0, it's negative. It's very negative. Okay, next. U.S. jobs reports, this is what I was talking about. These are just the actual published numbers. It goes back to the early 2000s. Notice every time there's a peak, there's a trough, a peak, a trough, a peak. That happened before the credit crisis. It's happening now. And that's just the statistical quirk and how they do the numbers, which is really screwed up. They have no idea what they're doing. And maybe they do. There's a combination of stupidity and just illicitness. Next. Mortgage and debt. This is just a comment on the housing market. People can only have so much debt based on their salaries. We went to this astronomical level. And that 171 is after the peak of the market, 2 years later. The market peak in 2006. And it's now really, really high. And that's actually it's really much higher than it seems to be. It's very high here, but it's actually much higher than it seems to be, because there's been actually companies that have bought thousands and thousands and thousands of houses. So they don't have a salary or anything. So these corporate buys don't fit into the description as anything so better. Okay, next. Okay, we've done this chart before. I'm just showing you through it. This is the S&P corporate profits and jobs. You see the percentage of employment, it's that red line. There's been no real recovery of jobs. Reading the papers are here and they recovery. No, all these people left the labor force, so there's actually no more jobs. It's that the unemployment rate became better because other people left to live. So it looks really bad. But the stock market keeps going up and corporate profits keep going up. And that happens because the Fed has 0% interest rates. And the stock market goes up because quantitative easing puts even more money. A lot of corporations, especially the big ones, have lots of debt. So you have 0% interest rates, you lower the amount of money they pay on debt, and that increases their profits tremendously. It's not that they're more efficient, or they did something better, or they're better marketing, or they open global markets or anything. It's just a gift given to them, basically. It's not that they're smarter or better. So next. The Fed balance sheet, it's probably a little higher than this. QE1 is that first thing on the left, QE2 is sort of in the middle, wasn't too big, and QE3 has been much, much bigger than all of them. And that's what on and on and on. So, and that's what's pushed the stock market to hold on. Fiscal state, we always do this. The national debt is 17.7 trillion. When we first started discussing this in early 2008, it was 9 trillion, just a little over 9 trillion. So in this time span of this meetup, when we've been discussing this, and that's not the whole time span of this meetup, that went from 9 trillion to 17.7 trillion. And in 9 trillion, we were complaining like, God, this is so outrageous, and look how big this is. 17.7 trillion, it's more outrageous. And the growth has slowed down temporarily, but expect that it's going to pick up later on in the next few years. So there's also 3.1 trillion in state and local debt. Now, in foreign countries, they usually put both of those debts together to get a debt-to-GDP ratio. So if you want to do this with the U.S. to compare to like European countries or Australia, you've got to add those two numbers, and our debt-to-GDP ratio with just the national debt is 106%. You add those two numbers, it's 124%. Now, when Greece hit 120%, the entire economy collapsed. So we are over that Greece number. Now, we have the reserve currency of the world, so we can go way above that. Yeah, Greece is a small country that's very vulnerable. So, but we're at that really irresponsible bad level. And Japan's way over 200%, which is historically, it's never happened. And I maintain that after several years, Japan will collapse at some point, and that collapse will be very swift and take everyone by surprise. You know, it will not be a surprise at all. So our GDP is government claims our GDP is 16.8 trillion. That's grossly overstated. So using that number, we get to 106 and 124. If we actually had an accurate inflation rate and took out some of the garbage they put in GDP, maybe that would be 12 trillion or something like that. It would be a few trillion less. So, I mean, these lies are eventually going to catch up with us. Unfunded liabilities, this is a somewhat arbitrary figure. This means the amount of money we owe to Social Security, Medicaid, Medicare, into the future. Now, you can take how many years in the future you want and you have to make certain assumptions. So people come up with different numbers. This is some huge number, whatever approach you take. And these people, the national debt box, claim 116 trillion. Now, the total national assets, that's all the value of everything in the United States, is 113 trillion. So we're broke, and we will owe in the future at least 116 trillion, and that doesn't include this other stuff. So, hey, we really have no money. And that's with a lot of optimistic assumptions. And realistically, we really do. And that debt, our national debt, does not include that Federal Reserve money printing, which it should, and that's like over $4 trillion. So that would push that 17.7 to 21, 22 immediately. And I actually went to a meeting a year and a half ago or so. There was a spokesman that came from Washington to the accounting group at Brewer College, and it was how we're reforming, how we calculate the debt. And they say, oh, we're going to get this 50,000, this 100,000, this million here. And so I raised my hand and said, well, are you going to include the Federal Reserve money printing? He said, that actually was discussed. We decided not to do that. Now that's $4 trillion, but they're going to get the 50,000 and the 100,000. So I said, this is just another government BS, like committee in operation. Oh, look, we're doing something. And you know, the real stuff, the real gaps, we're not doing that. So, and the guy gave me a dirty look when I asked this question. He said, oh, wait a minute. So I mean, I like asking such questions. So, total debt in the, not only is the Federal Reserve, the government nationalized Fannie Mae Freddie Mac, they have $5 trillion in debt. That's also not on these books here. And FHA has taken over the mortgage insurance obligations after 2008. That's also not on these books. And there's a lot of other things. When we had the Iraq War, that was not on the national debt either. That was run off budget. So as bad as the figures are, they're much worse. There's all sorts of stuff floating around there. You know, you're not told about it. It's not everything. So the national debt clock estimates that all the debt in the United States is $61.6 trillion. That's like consumer debt, business debt, government debt. So, and well, the assets are 113. Well, that's like pretty bad. You know, we're half as much as we think. Then we have all these other obligations that we're doing that. So, like, hello, Peter. It's nice to see you. So, student loans is going to be the next crisis. This just jumped up to help solve the problem, unemployment problems in 2008. The government flooded the world with student loans, telling everyone, go back to school. Oh, you're 75 years old, that's fine, go back to school, go back to school. We'll lend you all the money you want. So people borrowed all this money to go back to school, and they're not getting any jobs from the school they went to, they have to use debt. And already in 2011, probably with 600,000 defaults. You can't get rid of this debt in bankruptcy, so once you have it, you're stuck with it. And that won't continue. There's going to have to be some big, like, oh, we'll forgive everyone's debt, or oh, we'll forgive people's debt. So just more like if you're irresponsible, waste money, the taxpayers will clean up your mess. So that will happen at some point in the future. The budget deficit, we'll know what it actually is soon. The fiscal year ends in September 30th. So maybe by end of October, we'll know the actual number. It could be something like this, if it's not a clean number, but God knows what they didn't put in it. So the trade deficit last year was $691 billion. We have to print money or borrow money for this also. This has been going up lately. So that's just another problem sitting around there. We've had a trade deficit since the 1970s continually. Once we left the gold, if you look, we left the gold standard, a couple years later, developed a permanent trade deficit. And this is an important point I make. Every time we've been back to historically average interest rates, the U.S. would be bankrupt. And that means like 5-6% interest rates. And those are, you know, average rates for over 100, 200, 150, 200 years. And they've been again self-said 2 months ago thereabouts, I don't expect interest rates above zero or much above zero in my lifetime. Now, he's maybe 60 years old, so he probably has 20, 25 years at least left. So that was like an eyebrow-raising comment, what people say. Now, or people say maybe he has a serious disease. We don't know. We can next. So, but no, as far as I know, he meant 20, 25 years with 0%. Now, Japan has actually had a 0% interest rate, maybe 15 years already or thereabouts. So, and they could easily make 25. We'll see a chart. The global news, well, we're lying about the economy saying it's really good here. The Europeans and Japanese don't lie as well. GDP last quarter in the EU was 0%. 0.0, no growth whatsoever. And they're lying too. That's an example. It's definitely Japan admitted it's minus 7.1%. Minus. That is not just a depression, it's a bad depression. And people, stock market goes up, no problem. So, I mean, this is like unbelievable trouble. And the Japanese economy has been dead for 25 years. And, you know, peaked around 89 and that's it. And there's no reason to think it's going to be better. I've been told some really terrible things. So what the ECB did, they said, oh, we have no growth. They lowered some minor interest rates. There's a deposit rate with the central bank, and that's now minus 0.20%. That's an interest rate. And the refinancing rate is a plus 0.05%. So that you actually, and that's actually positive. Now, in theory, you cannot have negative interest rates. In a free market, you cannot have negative. So if you have negative interest rates, you do not only you don't have a free market, you don't remotely have a free market. The central bank has so screwed up the market that these theoretical impossibilities are taking place. And that's not all. There's actually more negative rates in the yields. This is the one thing you must pay attention to. We've got 8 days left. There's a referendum in the UK on Scottish independence, and that Scotland will break off from the, separate from England if it passes. Now, a month ago, this was losing by about 20%. It was just before it came out, and it was winning by 4. So the momentum is way in favor of independence. If this happens, the proverbial fan will be hit in Europe and the rest of the world. And maybe it will be jerky in first, but really bad things can happen. This will be absolutely happen with the global financial system. So people will not know what's going on. And we will see in a few charts in a couple of minutes how people are already reacting to this, traders, and anticipating this. Meanwhile, on the other side of the planet, China has posted a record trade surplus. That's good for their economy. It's trade-based. The record trade surplus is with the United States, is one of the things. So that's bad for us. So that's going to hurt us, our economy. Ukraine is still a total complete mess. There's a temporary ceasefire. Lots of luck if that lasts. Israel and Gaza have a temporary ceasefire. Lots of luck if that lasts. I mean, these are trouble spots. They're going to remain trouble spots. ISIS is still a threat. We're bombing them. Obama actually made a statement 2 weeks ago. We have no plan, but we should come up with one. And I think it's still great confidence in the world, saying like, oh, he knows what he's doing. So I mean, now we say, oh, I'll take care of it. So, well, he did a great job so far. And Ebola, you don't have Ebola virus, you're not going to get it. And you're going to read more and more in the papers and see more and more Ebola, you know. And this has already happened. The United States already has $88 million in its budget for Ebola containment or, you know, dealing with Ebola. And there's no indigenous cases. We've just imported like 3 or 4 people from Liberia. So already, and there are vested interests that want us to spend $1 billion. And we're going to see, oh, we have to get an Ebola vaccine, and we're going to have to do this. And so, like, there's a lot of medical interest that we're going to make a lot of money with this. It is not a threat. Ebola is actually very non-contagious. It's not contagious until symptoms show up, and those symptoms are very obvious. And you have to actually come in contact with fluid from the victim. So, avoid people with blood coming out of their eyes. It's not that difficult. Now, why is this?
No, I was going to say, because the other one is, considering the building we're in, issues with Estonia as well.
It should be what?
Estonia, in terms of not connected to Ebola, but just what's happened recently with Estonia.
Oh, okay. That's not even on my radar. We should have an Estonia. Kind of go through the screen. See what they say. Anyway, we have to go back down. There's a reason why this is a problem in Liberia and Sierra Leone. Liberia actually had a case where it didn't even have running water for a couple of years under its last dictator. I mean, this is how the country is so sort of Stone Age level, basically. And it's because of bad politics, incredible poverty, incredible filth. I mean, the disease will spread in such conditions. These conditions don't exist in the United States, except in Detroit. That's what I'm saying. So, and they're even estimating on it. 20,000 people could get Ebola. Well, the population is millions and millions and millions. And then more people die of the flu here every year than that number. And people aren't like running around screaming, the flu, So, I mean, even though this is a worst case scenario for your company. This is an attempt by the medical establishment to make a lot of money. So, I mean, maybe we'll panic the market, but I know this. Next. The real people run the market are actually quite small. GDP growth by the economy since 2007. This is showing you what's happening in the Eurozone, UK, Japan. It's actually negative. US is claiming it's positive because they're lying more than they are. You see in that right chart within the EU, Spain and Italy are like at the negative growth. They've never been fixed. And Germany and France are very moderate growth. In fact, Italy just at the GDP figures came out, they were negative. And there were 11 negative figures out of the last 12 quarters. And then the articles said, oh, maybe they didn't really recover. Well, you know, if you have no negative GDP growth, yeah, I think that's a good evidence of recovery. I mean, but meanwhile, there's recovery, so levels. Next. Okay, here's inflation. This is official inflation rates, and the EU is panicking about deflation. And notice that I got this chart from an article, and this is without food and energy. So, I mean, the two major sources of inflation are food and energy. So you take them out, hey, you don't have much inflation. Wow, that's like, you know, swift. So, I mean, and this concept of core inflation was invented in the United States in the late 70s and sort of early mid-70s by Arthur Burns, who was a Fed chair, Nixon's Fed chair, Nixon. And they said, oh, inflation is such a bad political thing. He said, oh, okay, we'll create this thing called core inflation. Take out food and energy, there won't be any inflation. And this was a public relations gambit. Now it is part of official policy. The Fed actually looks at core inflation, economists look at core. It was a joke. And now it's like the essence of policy in the world. And it's like amazing. It's like the old adage, in Hollywood, you don't believe your own PR. Well, the economists believe their own PR. It's amazing. Next. Okay, here's the other thing I was talking about. 2-year government bond yields have been negative in a number of European countries. Once again, this is theoretically impossible. People will not give you an investment and pay you to take the investment. So, as you can see in Germany, Netherlands, and France, they're negative. And the other countries are just a tinge above zero. So this cannot be happening, but it can happen. So when you see things like that cannot happen that are happening, you have to say, well, there's extra information that I don't know about. And the central banks are manipulating the system so much, they're creating this complete misallocation of capital. And Japan has done this next, maybe this is soon. There it is. There's the interest rates in Japan, they hit zero in the late 90s, they've been around zero since then. And Japan has done this. It was the leader in the world that created these zero interest rates. And the economy has been dead and has remained dead. And no one gets the lesson, none of the economists get the lesson, like, it doesn't work. And the reason it doesn't work, and common sense, it can potentially work in the very, very short term. Now, after 15 years, that's not short term. If you have no reward for savings, you don't pay people anything, people don't save. Now, savings is produces the capital for economic growth. So if you have no savings, you have no future economic growth. So if you do this for years and years and years, you don't have any economic growth. And that's exactly what's happened in Japan. It's exactly what classic economics would predict. Now, Keynesian economics, which came along in the 30s, said, oh no, we can have all this magic and this works and we can produce these artificial interest rates and the economy recovers. Well, it doesn't work in reality. We now see it in reality. That has not stopped governments or economists from using it. Next. Okay, let's look at the charts and we'll see some of this how it's affecting markets. The big story right now is currency. And that's the one market that, and I don't mean forex. The dollar's been rallying very strongly, and the yen has been rallying a little, not tremendously. And those are the two safe haven currencies. And the euro pound has been falling drastically. And the euro is falling because of the 0% interest rates, negative interest rates, they fall. And the pound is falling because of the Scottish situation. And then the stock markets in the UK is falling. US treasuries are rallying, which means interest rates are falling, that's the same statement. And one reason for this is, again, David has said in his model that he's predicting lower interest rates in the bottom, at least testing, or a lower rate than we hit in 2008. He said this in two previous talks, actually. So if you look at US interest rates, which are like 2-3% for longer bonds, well, that's a lot better than European or Japanese rates. Our rates are actually high compared to the rest of the world, so capital is flowing here, because, you know, 1 is better than 0. So, interest rates could hit lower. This supports his case is technical, but this actually supports lower data. Meanwhile, the S&P hit 2000, this was the first, everyone's excited. That happened on the lowest non-holiday volume of the year. That is very negative. When a new high is hit or a breakout taking place, to take place on high volume, which indicates enthusiasm. The volume is extremely low, it indicates a lack of enthusiasm. And this has happened, there's been a 5-year pattern of dropping volume since the bottom in 2009, early 2009. And we're going to pay for that big time eventually. Commodities are sort of down lackluster, so they're doing nothing lately. The stock market's inching its way higher, and lots of activities taking place in currency. Okay, next. And bonds, you could say, are in a bubble. And one important thing about bubbles before we go on, people will say there's no bubble in the stock market right now. And I'd say they're correct, probably. They could be correct. David says there's no bubble. But that doesn't matter. There was no bubble in 2007, and the stock market completely collapsed because the real estate market collapsed. And it was really the loans of the real estate market. All you need for a stock market collapse is for there to be a bubble somewhere in some asset. Now, if you have negative interest rates in bonds, that's a bubble. But one definition of bubble, you go totally disconnected from realistic values. And when you have negative bond rates, that's about as disconnected as you can get from reality. So there's definitely a bubble there. So all you need is one, and that can collapse every other market. So remember that. And that's what happened in 2008. The bubble was not in the stock market. It was actually in the real estate market. Now, this is QE tapering, another chart. This red is what happened when they stopped the tapering previously. The market started going straight down when they stopped the QE. So now they realized in that lesson, we just can't stop it cold turkey. We've got to gradually stop it. So they're using a model like a heroin addict model. And there's all these analogists. Yeah, I could see Janet Yellen shooting off. Putting that thing around everyone's doing. And that's the wrong model, actually. I've actually mentioned that myself. It's wrong, it's incorrect. The correct model is really the diabetic insulin model. And you cannot take less and less insulin and stop, and you'll be okay if you're diabetic. If you're a heroin addict, yeah, you can take less and less and less and gradually go off it. And, okay, that works. But diabetes, you actually need that to live. You must have that liquid stuff in you. Just like the economy actually needs the quantitative easing to keep, the market needs it to keep going, because it's artificially properly high. So you cannot stop it. And what happens is we're going to eventually have some big collapse. And that may be a decade or 2 decades later. It doesn't have to happen that year. But so they're using the wrong model. They're saying, okay, they cannot stop. And then, you can't take insulin away from a diabetic and you'll be okay if you gradually give them lots and lots. So this is going to be a disaster. So you already see the temperature getting lower, the market just can't go up, it's having trouble, it's gradually trouble. It's rising in agony. So it's going to start going down. Now, what can happen? Let's say there is a big drop, which I think we will be some sort of. And we had a big drop in '98, and David was looking at the Dow, but the Nasdaq was the index that really got hit. It went down 30% in a month. And in the Greenspan flooded the market with liquidity. He said, everything, instead of letting the bubble finally deflate, let's push it up to, and that created the final blow-off phase of the bubble. And that can happen again. I think there's a big risk of that. We'll have a drop. They'll try to pump huge amounts of liquidity in the market that's already saturated with liquidity and shoot everything up. This will also cause inflation to explode, much worse than it is. And everything, it'll be over at that point. So that is a likely scenario. Keep that in mind. Okay, next. Okay, New York margin debt, we keep mentioning this. This only goes up to May, I think. This hit a high in the late 90s, it hit a high in 2007. It's hit a brand new high now. Each peak it keeps hitting a new high. And this is a sign of a peak. It's a contrarian indicator. So we keep climbing and we're testing that level. Once it starts going down, it's over pretty quickly after. And this only goes up to May, so it's 3 months off. Next. I couldn't find a more recent chart. Investors intelligence bear sentiment. I've been doing charts like this for several months. It is the same as it was in '89 up to a month ago or so. It's now as low as it was in 1987. This is a contrarian indicator. And of course, nothing bad happened in 1987. The market just kept going right up. People were totally bullish. The market can't go down. Kabum. It's just totally flat. And they would say it went down 30%, actually went down 40%. And maybe the Dow went down 30%. So, but the broader market went down 40%. And some tech stocks got hit 80, 90%. So things had changed on the dime, which they found out in 1987. And in 1929. So this sentiment is at that same level as 87. So this is in danger, severe danger territory. And if we look, we can find lots of things in severe danger territory. And at the top, everyone is all optimistic. The vast majority of people, not me, I'm always pessimist. But that's our way at the top. And if you have no bears left, everyone's a bull, there's no one left to buy. Because the bulls all bought and say, I'm bullish, and you've got to keep getting new money. There's no new money from new place. And that's why market's in bull ball. Next. And we're at the 87. That doesn't mean we're going to have a crash. I think we're way over. The Dow, here's some charts. You see the Dow has been going up. These are weekly charts, so they're like 3 years, they're longer term. Not really long term, but long term. You see the Dow has been going up, and you see that RSI has been decaying for like a year and a half now. So that's very negative. There's multiple negative divergences here. And 1 is bad, 2 is worse, 3 is really bad, 4 is like disastrous, 5 is so this is really like a warning. It's going up as losing internal strength for like a year and a half. That's really low. So, and technically that thing at the bottom is a rally, but not really. It's so weak. Next. So this is bad news. The S&P is bad news, but not quite as long. It's only like about almost a year, a little less than a year. And that's also technically a rally, but it's not as weak as the Dow. The Dow is in weaker shape than the S&P Nasdaq. Next, we'll calm down. Nasdaq also has this decline. It's like a little over a year, about a year or two. Same type of pattern. The bottom, though, is healthier. That on the DMI at the bottom, that's actually a healthy buy signal, rally signal. So Nasdaq's in a little better shape. The Dow's in a little awful shape. Next. Okay, Russell, this was the big, Russell has a big rally. All indices. Here it's been flat, it looks like it's a triple top. And it says, a little over a year it's had that negative, series of negative divergence. And you see the decline on the MACD, that's the second thing. That doesn't look good either. And it's not on a buy signal in that bottom, that's actually neutral, it's trendless right there. So this is not something that looks like it's going to have a continued rally. It's like gotten very weak, very vulnerable for a sharp drop. Next. Okay, the DAX in Germany. Notice it has a sort of similar pattern, except the price is actually going down a little.
had the same type of rise, and the RSI was decaying. You see the MACD is decaying. It's actually on a sell signal. It's weak. It's sort of neutrally. So this is sort of weak. This is the German market. Next. Okay, FTSE. We're going to see the pound in a minute. This is at this very broad top, which has been going on forever, for a year and a half. You see the RSI has been decaying that entire time for a year and a half. You see the MACD has been decaying. That bottom thing is like trimless. That very low black line and the blue and red lines wrapped around each other. There's no trim. So it's not like a rally or anything. This does not look good. This market could fall apart instantly. And it might. We'll find out in the next month. So next. Now here's the pound. Look at the pound in the last 5-6 weeks. Each bar is a week. Notice that that's just falling out of bed. It's just like collapsing on top. And that's that fear of the Scottish referendum winning. As the polls got better, the pound was spreading. Notice it's gap down. I mean, not going nice and smoothly down, it's going down in chunks. So if that referendum won, I mean, you should assume there'd be a big collapse. And money will flow out of England because people will be confused. The dollar will certainly rally, the pound will go down, the FTSE will go down. Money will probably flow out of Europe. The RSI is really weak, it's going into strong into territory. So the MACD is trying to, it hasn't yet, so that's a plus. That bottom thing is a strong sell signal. So, and it makes sense because it's selling very strongly. So it's going down like a rock. Okay, next. So this is warning you. This is these people are afraid of the traders are afraid of that Scottish referendum. There it is in black and white market. Here's the Nikkei. It's now this the Nikkei also the yen also had a big drop for different reasons, and I'm going to point these two things out to you. The government in Japan caused the yen to go down. It wasn't external factors or traders. And they did that purposely to improve the economy and improving growth. And this drove the stock market up. This is not what's happening in the UK. Money is flowing out of the country, it's flowing out of the pound, it's flowing out of the stock market. But the pound first. So those are different factors. So they have opposite results. And it's important to know why the thing is happening. So the government did this, and it caused the Nikkei to almost double the price in 6 months. Now it's like sort of moving sideways for the next year after that. They've done this several times since 1990. They push the Nikkei, they do something to push the Nikkei way up. It eventually falls back down to 8,000. And they push it back up, it falls back down to 8,000. And they knock on the idea artificial tricks don't last forever. They're temporary, and then the market fixes itself. So they totally overdid this. Those red bars are way beyond anything acceptable. And then you have in this, there's really no trend in that bottom circle thing. So this is very sideways movement. Next, let's see the currency. This is the yen. And you see how the yen went way down. And now it's had a little rally with the pound dropping and the euro dropping, you don't see that yet. And so you see, this is actually one of the sell signal, strangely. Wow, this is not strange, it's going down. This is, yeah, it's inverted. So this is quite negative, but the government did the first part of this. The market is actually doing this little last 4 or 5 weeks. But that big drop in the middle is the government-induced drop. So you have to know what's going on behind the scenes. And that will have to fix itself at some point. Next. Okay, there's been a rally in China in the stock market. The market has been dead for years. It peaked in 2006 in a massive bubble. And that's a little overdone. That's what that little bar is on the right side. So that bottom circle says the trend is going to continue. It's going to have to come back down and touch that yellow line that was overextended. Next. Okay, Syntax in India. This is very bullish, way overdone. There's a lot of inflation in India, and that's what's driving the market up, actually. And markets should go up. It makes sense if this currency devaluation goes in Europe, blatant currency devaluation. And the rupee is losing value, and I've heard stories you actually see the inflation in India. You go shop from 1 week to you go the next week, the price is higher than the thing you bought last week. You actually see it. So this is what's driving the market up there. It's artificial. There's a very strong rally. That arrow at the bottom says that black line's as high as it should be. So this rally's overdone. It's got to have some corrections. Next. This is the Bovespa in Brazil. This has also been rallying. It looks like it made a double bottom in the last year and a half. So it's a little overdone at the moment, but it's coming down. This is trying to be bullish. Notice this pattern on the R side, that's the top thing, that line is going up, and the downward is going down, 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 down. Here's going up, up, up. That's the good side. That looks good. The downward red. And if you look at this bottom thing, you see the blue lines over the red line, which is positive, and the black line's rising. So this actually looks like a good chart. Maybe a little too high at the moment, but this is going to be positive. Next. Here's the RTS in Russia. Why does this chart look so funny and different from all the others? I take my charts from big charts. As soon as Russia annexed Crimea, the RTS chart disappeared from big charts. Now, if you actually do a search and say, are you RTS? It'll actually say, yes, that's the Russian trading system. It'll actually say that in big charts. And then so you put it in and said, no, we can't find any such thing, no such thing. So that happened, and it's disappeared from big charts. It was there for years and years and years. And like just suddenly, it must be one of the sanctions. Obama probably said big charts can't show the Russian market. I have no idea. It makes no sense at all. So I got this off like Bloomberg or some such things that the charts look very different. Now this is a 3-year chart, so you see the index has actually been going down for quite some time. You know, each peak is a lot lower than last week. And then when the problems in Ukraine started, it would drop to 1,000. In the credit crisis, it fell to 500, and the peak was 2,500 actually. So there's a downtrend. That downtrend started though in early 2011. It's not new with the Ukrainian situation. The Ukrainian situation is aggravating, and my guess is it will continue. God knows things are not resolved in Ukraine. We don't know what's going to happen. I'm just assuming all sorts of bad things are going to happen, of course. And there was a lot of support at 1,200 that was broken. So that's significant, and we should go lower. 1,000 is a good support too. So this seems to be a gradual drop. So we're going to use this chart, including the big charts, returns in this chart. Next. 10-year treasuries, you see, this is interest rates, not the price of bond. You see interest rates are drifting down, and this is yes, it's in there. And this chart's a little negative looking. Next, we'll see this is the 30-year treasury. You know, this is drifting down faster. It's also negative looking. It's more negative looking actually. And you see that bottom. It's like that. Those lines keep going to 40 and then go down. So we're sort of around there at the moment. So if there's a crisis, money comes into the dollar and U.S. treasuries. So like if Scotland votes to break off from England, you should assume there'll be a bond rally here in interest rates. And the dollar will run. Next. And here's the US dollar, which has been rallying quite strongly over the last few weeks. Remember that pound went down, 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 down? Well, here's the dollar going up, 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 up. And the euro looks the same way as that pound chart. We'll see it in a minute. Now, notice that first index hit 80, that's the RSI. 80 is the top, it should not go higher than that. It can go a little higher, but that's sort of a temporary peak. And this is way overextended from that gold line, and we're going to come back to it. That bottom circle, that's a very powerful, strong buy signal. So that's supporting that the dollar is very strong rally interest. Next. Okay, here's the euro. It's not as bad as the pound, but it's pretty bad. Notice the last several weeks, it's like having a drop. The pound's much worse. But you see, the charts are very negative. And just as the dollar went to 80, this went to 20. 20 is usually the low, and it can't get any lower. So you see the dollar euro are reacting exactly the opposite. So that looks like it should rally soon, and the dollar should sell off, according to the chart, so we'll see what happens. It may not work out quite that way. And that bottom circle, that's actually a strong sell signal. The dollar was a strong buy signal. This is like the mirror image. So, and it makes sense that the euro goes down and the dollar should go up. You know, some odd. So next. Okay, the franc is an important thing to watch. You don't want to buy euros. It's really a crap currency. The franc is a really good currency. But what they've done, they've tied their value to the euro. So if the euro goes down, the franc also goes down. Now that doesn't mean the franc is bad and the franc is worthless. It's artificially being pushed down. So we should take advantage of that. Now it got as low as 100, that's 1 franc per dollar. And in the early 70s, there were 5 Swiss francs per dollar. It's now 1 to 1. They got almost to 140. I got $1.40 to get 1 franc, where 20 cents used to buy you a franc. So the franc over time has gotten more and more valuable as the dollar has gotten less and less. So it's one of the good currencies in the world. Now, twice it got close to that 100, that means 1 franc per dollar. If it gets back there, you should be certainly consider buying it. That's like a very good buy. Doesn't mean you put them lower, but that's a good buy. And if you're not, we don't know yet what happens. This is actually on a sell signal much weaker than the euro sell signal. And the chart's somewhat negative, not quite as negative as the euro. But it simply is tied to the euro. It doesn't have an independent existence. And eventually that will break apart. It cannot be maintained forever. Next. Okay, here's the Australian dollar. This is tied to gold, or trades with gold. This has shown some weakness lately. It was around 87. That was actually a very good buy. And we'll go back to 90. It's like a reverse and showing like the bottom of 87. That might be a reasonable buy at that point. This has gained strength over the last year, though. The very strong bottom was put in that bars at the bottom. And that's last August, September, October. So, but the real bottom took place, the price bottom took place later. The technical bottom took place earlier. Okay, so if this had a big drop, well, under 90, it's probably a good drop. Next. Okay, here's copper. This looks quite different. It's a 3-year chart. This looks like the Russian market. It's been declining more gradually than the Russian market over many years. So it's been bearish. This is telling you the state of the global manufacturing economy. It's actually been losing strength for almost 3 years now. So this is quite negative for the economy, and it's also negative for copper. Now this nice circle, this huge circle, this is actually one sell signal after another, after another. This is actually a very bearish chart, although the decline is very slow and gradual. It's not rapid, but it's the chart pattern on the bottom is incredibly negative. Next. Okay, oil has had a sell-off lately, but it also had a big sell-off last June to October. So notice how much money around the same amount. The oil market's not dealing with reality at the moment. There's all sorts of propaganda and stuff like that. Although the price is not going down, hovers around 100. It tends to be weak in the fall. It's the seasonal. So if there's weakness ahead, it's okay. It makes sense. A bottom tends to take place in December, somewhere between December and February. So next. Okay, quick. Next. Gold is going nowhere fast, and I think it's going to continue to go nowhere fast for an indeterminate amount of time. We will see. It's actually making a huge base. One day we'll have a big rally and go back to that 170 level. Next. Silver's making a huge base also. And notice it has a gap in that chart. It's going to fill that gap at some point. Both the gold and silver charts have lots of gaps in the daily chart, way above their current price, way above. And they will have to go back and fill those gaps. Next. Miners are doing well, now they're sort of selling off. This chart thing at the bottom is totally neutral. It's telling you nothing. Next. Morphe had a nice rally, we predicted this, and it's stuck at 40. It may sell off, there's some weakness in that chart, so we're going to come back to 30 or high 20s. If it does, it'll be a good bond at that point. Next. Coal is dead. Barton is like gotten, Dennis Garment was very hot on coal in the last couple of weeks out of nowhere. So we've been watching for a long time. This chart's still pretty dead looking. Next. I don't get too excited either. And it's not like it'll go down, but it doesn't get so long. We like uranium. This is the uranium companies. This is also going sideways forever. There's actually huge demand for uranium in the world. So eventually, and the supply is shrinking. So eventually, this is going to have a very good pop too. It doesn't look like anything's going to happen immediately, so don't get too excited. Next. That's it. That's the end. Thank you very much for today.